Welcome to StockGPTchat.com. Here, we help you visualize the past of the stock market so you could outperform the future. Our journey here started when we came up with the idea that if we bought cheap and undervalued stocks that were considered lower in risk, then we would outperform more expensive and high-risk stocks. From a logical, intuitive perspective, this made sense to us, but we needed to test out this hypothesis. So first, we needed data. So we went back all the way 38 years and got as much data as possible, and we cleaned it up as much as we could. We accounted for all the stocks that were getting delisted, all the splits, all the dividends payout, and we calculated the original snapshot of what those stocks looked like in the past. So this gave us 457 snapshots of 457 months in the past. Now we would be able to start doing our analysis. But in order to do so, as we said earlier, that our hypothesis was to find cheap and undervalued stocks and compare those to expensive and high-risk stocks. So to lay that out, we needed to introduce a model that would give us a valuation of cheap and a valuation of risk without introducing any sort of bias. So we came up with a model to do just that, and all we did was rank ordered every stock so we could compare every stock to every other stock. This, from a layout perspective, was very intuitive and it logically laid out the entire market in front of us. But this still didn't tell us anything because what we need to do at this point is compare every snapshot with every other snapshot. And in this way, every month gets compared to the subsequent month, and so we could start seeing the performance. And that performance we laid out on a matrix grid, and that showed us exactly as what we were hoping and confirmed our hypothesis was correct. Because month over month we saw the same kind of results because most of the green or in the positive performance was on the cheap and the low risk side. And after our hypothesis was correct, it was time for us to get granular and go deep into the data and compute compounded returns for each of these sections of the market. And so then we created zones across the entire matrix and then ran reports that gave us exact compounded returns, the exact number of trades, and what that exact return would look like. And from that point on, our best performing zone became our strong buy zone, and the worst performing zone became our strong sell or short zone. Now again, no bias came into this model. We weren't trying to predict anything. All we wanted to see is logically lay out the data and see the insights. Now, the astonishing thing about this entire research is how the strong buy zones compare with the S&P 500 benchmark. In the 38 years of this analysis, the S&P 500 has appreciated at 2,163%, while our strong buy zone has appreciated at 135,692%. A remarkable outperformance. And so using the same approach, we're now able to build screeners and rank and rate every single stock in the market for every single day. We then applied the same exact structure and model to other international markets as well as crypto and forex markets, and we got back the same exact results. And so all of those products are working and available at StockGPTchat.com.